Hello everyone, welcome to today's US Open live session. 10 minutes before Wall Street opens, as always, every day. Today, of course, it's Monday, February the 12th. I am your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. Today, we will be focusing on the inflation data coming over the next couple of weeks from the United States and the UK. Important data because they will affect the policy path from the central banks of both sides of the Atlantic and their respective currencies as well. And we're also going to focus on the euro dollar, the cable, and the NASDAQ. Before, however, we begin, please, as always, read carefully through the risk warnings and the disclaimers. Once again, please go over the risk disclaimers and the warnings carefully, and bear in mind that anything discussed in this session does not constitute investment advice and should not be construed as such. I will give you a few more seconds to go over the disclaimers, and then we will begin. Okay, let's get the ball rolling. We're gonna start off with the UK inflation and the US inflation, both for the consumer price index, which are coming up on Tuesday and Wednesday. Tuesday US, Wednesday UK. We're gonna start off with the UK, and this headline a very busy week, mostly for the UK, multiple releases from the United Kingdom, and then we're gonna see how this bode with the monetary policy path, and of course we're gonna talk about the technical outlook of Euro USD, GBP USD, and the NASDAQ 100. So let's start with the UK inflation figures, which come up on Wednesday. We already talked about those releases, upcoming releases on Friday, but let's talk a little bit about them more today. The UK suffered more than the US by the high cost of living, but inflation has decelerated sharply after the 4 decades peak of October 2022, double digits, as you can see here on the chart. Now, of course, as other central banks did to combat inflation, they tightened their policy. The Bank of England has already delivered 525 basis points of rate increases. And of course, taking into account the adverse economic impact, policymakers are now in a place where look to stop tightening, and they have already pointed to peak rates. However, the last print shown an uptick on November. That was the first increase since of the last year, came in December. Now, at 4%, it is still far from the central bank's 2% goal, and officials don't expect this target to be reached before the end of 2025. They still have work to do, and they have stressed the need for sustained restrictive stance and did not embrace rate cuts a couple of weeks back when they announced their latest policy decision. So crucial piece of data, again, that's on Wednesday for the Bank of England. Before this report, we expect wages data from the UK. They have also eased significantly, but remain historically high. Of course, uh, elevated pay pushes overall inflation up. On Thursday, we also expect the preliminary Q4 GDP data, with the economy having contracted in Q3 in the last quarter. So it will be interesting to see if we're going to have a technical recession there. And of course, we also have Governor Bailey speaking later today. We don't know if he's going to touch on policy, but there is a speech scheduled for later today in a few hours from now. And now let's turn to US CPI inflation, which is due on Tuesday. Of course, if there are any comments around what we're talking about, any opinions, we'd love to hear them. You can type them in the chat box. Or if there are any questions, of course. Now, on the US front, similar to what is happening in the UK, we have seen those price pressures moderating significantly. And Friday's CPI revisions, we touched on that in our last session, confirmed the disinflationary trend. Officials essentially believe that the terminal rate has been reached. They alluded to that essentially with their updated policy statement, and have pointed to 3 rate cuts this year. On the other hand, recent data have showed persistence. You can see how, if we turn over to the US inflation, you can see that there was a 4-decade peak, much lower than the one in the UK, didn't reach double digits. And then there has been a significant drop. But as you can see, essentially, since summer, inflation has been sticky. That's CPI inflation. And in fact, it accelerated in December to 3.4%. So, along with a strong economy and a strong labor market, the Fed essentially has no reason to rush into slashing rates and pushed back against aggressive market bets recently. So again, crucial data here. Of course, the Fed is also targeting a 2% inflation target, as most major central banks, but it's less clear which inflation it targets. Essentially targets the personal consumption expenditures, the PCE, but there is some debate, and of course it looks at all of those factors. PCE inflation, of course, is a little bit lower than the CPI. It's a little less inflationary, let's say. Now, so it is clear that the importance of this incoming data is significant because it will affect the policy path of both central banks and, as such, the respective currencies and respective stock markets as well. And those come at a period where monetary policy is in an intricate phase as central banks look to end tightening and eventually start lowering rates. Now let's turn over to Euro USD. Monetary policy is a bit murky at this stage because both central banks have hinted at peak rates, but and one would expect the ECB to be more ready for a pivot because the economy is at a much worse place compared to the US, and contrary to the US, where it outperforms. But the ECB has generally been more hawkish, and President Lagarde thinks it's premature to discuss lowering rates. Now, the recent Fed repricing has put bias to the downside, and the pair is exposed to the 76.4% Fibonacci, although a strong catalyst would be required for a breach of that level. On the other hand, more hawkish ECB and the recent repricing around the Fed that we referenced could lead to a return above the 200-period EMA, but the upside does not look particularly friendly. You can see that there is this thick daily Ichimoku cloud, and that makes the road towards 1.1017 unfriendly. Let's say, in a bit rocky. In any case, bias is on the downside at this point, but the incoming data will likely determine the trajectory. Now let's switch over to the cable. The pair continues to lack firm direction. You can see how essentially for the past several weeks there's no clear direction. As markets contemplate the rate path on both sides by the central banks on both sides of the Atlantic, and they await the pivotal inflation figures we talked about. The pair is exposed to the 38.2% Fibonacci, but fresh impetus would be needed for sustained weakness below it. And again, the daily Ichimoku cloud plays a role here, but at this point it can provide support to further downward pressures. And in any case, the next support area at around 1.23 looks distant at this point. On the other hand, the Bank of England is further from its inflation target and from a pivot compared to its US counterpart. This can be supportive of the pound, which already defended the aforementioned critical tech level, the 38.2% Fibonacci. You can see, of course, that right here, you can see how it has already defended this crucial technical level. This gives it the opportunity to push for higher highs, which are located at 1.2828. That's the December peak. But it will need a catalyst in order to achieve that. I need to say, however, that the pound may struggle to elicit support from a potential sticky inflation number and prolonged restrictive stance, because this could harm the already ailing economy. The greenback has more to gain from such themes if we see a strong inflation print, because markets are convinced of a soft landing, and in any case, the economy is doing much better in the US. And now let's round things off with the NAS100. The index has not been deterred by the Fed's pushback, as markets still price in multiple rate cuts, even if they have moderated their expectations, and they are convinced of a soft landing, while recent slew of tech earnings was mostly good. As such, it sets new record highs and looks towards 18,264. That's the next resistance area I'm looking at. However, we have said that technical conditions may be getting ripe for a pullback. There are two technical indicators that cause some concern. The one is the relative strength index, which points to overbought conditions, well above 70, and the other is the average true range, which essentially measures volatility, and you can see how over the past few days, this month, essentially volatility has been dropping, and it has been to the lowest levels essentially of pretty much of the year. And that does not bode well for ascending prospects, because these would need traders to back them, let's say, and the ATR points to hints that this doesn't exist. So maybe this recent rise is, I don't know, perhaps short covering or something like that. As such, a pullback could be in play here. Of course, that would depend largely on the CPI data that we expect tomorrow. And a significant change in sentiment would be required for the 200 period EMA at around 17, a little below 17,200. For the bullish momentum to be, for this technical level and the bullish momentum to be endangered. So this is pretty much it from me for today. So as we wrap things up, if there are any opinions or questions, feel free to type them. So all in all, a big week for data, especially from the UK. These are headlined by the US and the UK CPI inflation coming on Tuesday and Wednesday respectively. This will affect the policy path of the central banks, the respective central banks on both sides of the Atlantic, and of course their respective currency. Technically, at least for the euro dollar and the cable, we have seen, especially for the cable, we have seen some inconclusive moves recently, and this in more direction could potentially be provided by those releases. In any case, we will be here every day, 10 minutes before Wall Street opens to discuss their outcome. That's it from me. Thank you for joining me.